Here we are with Professor Aswath Damodaran in his visit to Argentina. Welcome to Argentina, Professor Damodaran.
Thank you. I'm glad to be here.
We would like to share some thoughts of you about valuation, which is your main field of expertise. And we were thinking that for emerging markets, for instance, for Argentina, you may have that in the last 10 years, stocks have earned, taking apart dividends, like 6% annually in dollars. Mm-hmm. And if you see the SP, it might have earned the same. You may say that if you are in Argentina, you expect to earn more than that. Do you think that investors should be happy with that return? I mean, and how does it affect the ex-ante calculation with the ex-post calculation of the cost of capital or the return on equity?
The thing we have to remember with stocks is 10 years is a slice of history that is really short. So when we talk about earning a higher return on riskier stocks, and you ask me, will it happen over the next 10 years? My answer is probably not. You could earn a lot more or a lot less, because in the history of the market, 10 years is like a blink of time. Okay. In fact, it's been estimated that for making these judgments, you're talking about a 100-year, 200-year, 250-year period, which effectively means that you can have a 10-year period where stocks not only earn lower than what you'd expect, they earn less than a risk-free investment would have, which makes no sense ex ante, but ex post. Between 2001 and 2010, for instance, in the US, stocks actually earned a lower return than you'd have earned investing in a T-bond.
Okay.
If you'd known that in 2000, you'd never have invested in stocks, but we don't have that benefit of hindsight.
Okay, but when you are thinking about the future and you are in Argentina, and you may try to calculate the cost of capital of equity, perhaps you may settle for a lower value than what the market says. Suppose that you were adding values, the risk-free, the market risk, and some sort of sovereign risk, for instance, or default risk. So do you think investors in equity should settle for a lower?
That would be a horrible mistake if you did, and here's why. You look back at the last 10 years and you said that was a bad 10-year period, we should have earned less. But if you bring down your expectations now because you had a bad 10 years, you're not doing what you're supposed to do when you invest, which is to demand a higher return because you take risk. In fact, I would go the other direction. If I had a 10-year period of investing in Argentina and I made the same returns I would have investing in the US, the way I think about it is the next 10 years, I better make twice the premium I should usually make to get back to steady state. Because I've, in a sense, been exposed to a lot of risk for which I didn't get rewarded, and I'm hoping that it catches up with me.
And do you think it may happen in the future that you can catch up for that?
It does, right? You look at emerging markets and you look at Latin America, you go through these waves, right? You go, you take Brazil, you had the 80s through the 90s, which were a destructive decade for returns, and then you had the 2001 to 2010 incredibly prosperous period, and now they're going through a downturn. So I'm sure they will have the same question next year as Argentina has, looking back at the last 10 years, but this too shall pass. There are good periods, there are bad periods, and guess what? That's why you get a risk premium. Because if I could guarantee you that risky markets always earn more than safe markets, it's kind of a statement doesn't make sense, and the market is not risky.
I follow you, exactly. And if you were an investor in Argentina, for instance, not a financial investor, but someone who is willing to take projects, who is putting money and buying equipment, and then you want to calculate the present value of your future cash flows, for example, the dividends.
Right.
What are the models that you have studied that are up to date that may help this person, to calculate the cost of capital? I mean, I'm talking, for instance, the main model is the CAPM, the Capital Asset Pricing Model. Are there new models that you may suggest to use?
I think people are looking for silver bullets. Basically, they want a model to give them a number. I'll keep this very simple. There are three inputs you need to go to a hurdle rate or a cost of equity. You need a riskless rate, and that choice will depend on whether you decide to do things in US dollars or Argentine pesos. You need a measure of relative risk. All you're saying there is not all stocks are equally risky. Some are more risky than others. And thirdly, you need a measure of the risk premium you would demand for the average risk investment. A risk-free rate, a measure of relative risk, and the risk premium for an average risk investment. The CAPM, that take the form of a risk-free rate, a beta, and an equity risk premium, the arbitrage price. But I think if you strip it down to basics, that's what you're trying to do. And I'm an agnostic when it comes to models. I really don't think models matter very much.
And how do you calculate when you don't have a model then?
I'll tell you what.
When you are, for instance, trying to calculate the cost of capital for an owner of an Argentinian company or a person who is not diversified, who has no, or perhaps he doesn't want to have access to U.S. markets.
I'll tell you what, you tell me what you pay, I'll tell you what your risk premium is. It's a very simple proposition, right? Risk premiums are not abstractions. I'll make it a very simple example. Let's suppose you have a company that is delivering $10 in cash flows every year forever.
Yes.
Let's keep it simple. You could put in growth, you could make it complex. Let's say you tell me that you will pay $80 for that company. You know what you just told me? That your cost of equity is 12.5%.
You're right.
And that's, I think, the insight we need. We act like we can make up stuff on risk premiums and risk-free rates. The reality is there's a price of risk out there. At the start of every month in the US, I compute that, what I call an implied equity risk premium, backing it out of the market. You can do that in any market. And the way it manifests itself is people charge a high price for risk. The way it shows up is your stocks trade at 5 times earnings. Russian stocks trade at 4.5 times earnings. You know what that tells me? The cost of equity for a typical Russian company is 25%. Now a Russian company may say, I don't like that cost of equity, but you've got to be a price taker. It's not your choice to say, I like that, I don't like that. If investors are demanding that, you've got to try to deliver that in your product.
I follow your point regarding this, but when you have unsophisticated capital markets, you may end up with different rates of cost of capital according to different owners. Don't you? Do you agree with that?
Absolutely. Okay. And it's nothing to do with sophistication. You have different degrees of risk aversion, different needs for liquidity, different perceptions of relative risk. So if you have a company with thousands of shareholders, each actually comes in with a different cost of equity. And the challenge in finance is how do you decide which one to use? And the answer is actually very simple. It's the marginal investor's perspective that matters. The marginal investor is the one who sets prices at the margin. These are the investors who own lots of shares and trade those shares. So in most companies, it's not what you and I think about the cost of equity that matters, it's what that person, so BlackRock is investing in your company. I guarantee you, at the margin, BlackRock is the one who's determining what your cost of equity will be. And the rest of us, whether we like it or not, have to go along. That's what you do in the CAPM. We don't talk about this. When we use a beta, we are effectively assuming that the marginal investor is a diversified large investor, and we use their perspective on risk. It breaks down when you have a smaller Argentine company where the marginal investors might not be diversified, might be individual investors. And if that happens, that happens. You know?
Okay. And one point that triggers one of your answers, you said that you may have different degrees of risk aversion. Do you believe that the world is not only a mean variance world?
Of course it's not a mean
variance. You have higher moments?
No, even people who believe in mean variance theorems admit that it's not a mean variance world. The question is whether it makes enough of a difference that we want to bring in the other preferences. We know that people like big payoffs. That's preference for kurtosis. We know that people like positive payoffs over negative ones. It's a preference for skewness. So you can actually expand these models into the other moments of the distribution.
Yes.
But when people have tried to do that, what they've discovered is they get more realistic models in terms of bringing those things, but not enough of a payoff that it's worth the effort of trying. So it's not as if we're not aware of the limitations of the mean variance world. What we've discovered is trying to incorporate those limitations into models doesn't have enough of a payoff right now with the data that we have for us to try to bring incorporate them into your cost of equity or cost of capital.
And a final, I appreciate that you have you know that the Black-Scholes formula, regardless about the use of the formula, is a combination of two assets, and you need complete markets. In that case, don't you think that options are redundant? Because they are a linear combination of two existing assets?
It's true. You can.
So what are they valuing then?
Well, they're basically saying, I mean, let's face it, you can create a replicating portfolio for a call option and IBM. And that's what people used to do before you had option markets. We act like options were created 50 years ago. There have always been options. People always, But it is more expensive. In the Black-Scholes model, there are no transactions costs. You can sell short, you can go long, you can borrow at the riskless rate, you can lend at the riskless rate. The reality is, even with complete markets, we know we cannot do any of those things. So if you don't have listed options, it is going to be much more difficult for you to create those replicated, at least for most of us. And that's what will make the game unfair. The BlackRocks might be able to create those synthetic options pretty costlessly. But if you want to buy a call option,
you have economies of
exactly,
scale.
right? So in a sense, what creating options allows you to do is it allows every one of us to now say, I want to buy a call option in IBM and be able to do it. If we did not have that, and that was what was true before.
That rip off the rent from
exactly. In a sense, what will happen is the 2% large institutional investors will be able to create their synthetic options. The rest of us will not be able to.
Okay.
So it's a democratization of the options market to be able to trade options in small units.
Professor Damodaran, the last question.
Yeah.
Where do you think the theory of finance is going to now? What are the main issues that worry you, that you are happy to do research on?
I think the questions are really disruptive questions, questions about how the world has changed and how we need to change our practices. It's not so much theory. Theory is in a sense kind of frozen in time. Our practices have to adapt.
So everything has been discovered from your point of view?
It's not that it's been discovered, but we have a framework for thinking about the big principal questions. What we have a challenge with are the estimation questions. How do you estimate risk-free rates in a world where nothing might be risk-free, right? That fundamental questions.
The calibration of the model.
How do you price things when everything can become illiquid in a moment? I mean, in a sense, these are the questions that 2008 threw at us, right? Because we used to assume that those things would happen in Argentina, but they would not happen in the US or in developed markets. So we always had a safe harbor. If you're in Argentina, you didn't want to deal with those things, go invest in a developed market, you were told. And 2008 said that what if there's no such market? Where do we go then? How do we adapt our models? And that's, I think, the biggest challenge facing us is we have to live in a world where nothing is risk-free, everything could potentially become illiquid, that crises are a fact of life, that it's not a passing phase. This is the way the world is going to be. In a sense, it is a byproduct of globalization. We're all connected at the hip. So everybody's problem is everybody else's problem. Brazil goes through a crisis. Guess what? The rest of the world feels it at some level because we're all connected. This is one of the unpleasant side effects of globalization, is we're not insulated anymore. And the countries that try to act like they're insulated put themselves in serious jeopardy. I mean, I think about Venezuela trying to, in a sense, they're saying, we want to go away from this world. We want to, you can't. That's one of the things about globalization. You can go in, but you can't leave, right? It's like the Hotel California, the Eagles song, right? You can check in anytime you want, but you can never leave. Right?
Thank you very much, Professor, for your time. Thank you very much again.
Thank you.